Welcome back, and joining us for a look at the equity scene is Nesi Chetty from Stanlib. Thank you so much for your time, Nesi. Nesi, what have you made of market sentiment this week, and particularly today after we got that final GDP print from the US that was revised down from the initial estimate?
Yeah, good evening to you and your viewers, Zanati. We saw today SA markets in the red, and I guess if you look at US markets, they also opened a bit softer after that revision in GDP. We saw similar weakness in most currency markets as well. Zanati, what we're seeing, I guess, in markets is company earnings starting to filter through in most developed markets and SA as well. So some of the big tech companies have reported, the banks have reported interim results, and also some of the other big US corporates. And you're seeing across the board a mixed bag of company earnings. The tech companies, and I guess the big one last week was NVIDIA reporting, where they guided to very strong earnings still. So ultimately, investors are asking how much runway do we have left in terms of US earnings to go. The S&P took more than 2 years to gain, I guess, 1,000 points, but the pace of earnings growth could be a little bit more quick and could push the market high in the short term. Certainly, we're seeing revisions in earnings, and I guess if you look at a company like NVIDIA, the revenue is up almost 265%. When they reported, and they're still guiding, I guess, to a very healthy earnings outlook, where they're benefiting from still very continued growth in their GPU products. So I would say we're at a stage where each set of results coming out is being analyzed in terms of its the guidance, but also it's having some impact in terms of the equity earnings, which we see in the markets under pressure in the US.
All right, well, let's come back home and take a look at some of the company news that came out. AECI coming out there with results, revenue up 5.4%, but that not filtering down through to HIPS, which declined by 11.7%. Also, we saw that dividend declining by 79%. I did see that share price, interestingly, though, up by almost 3% at some point. What did investors hold on to here?
Yeah, I think if you look at it at a headline level, Zanati, I mean, headline was up 11%. So a good result, even at a revenue line as well. If we look at the operating environment, still very characterized by high interest rates, high inflation, they would have experienced some problems with supply chain logistics. And it's also been, I guess, a challenging commodity price environment as well. The one business that did very well in AECI was mining, which would have steered this strong reported results. They would have had very good revenue growth, but also volume on the bulk of explosive side would have gone up as well. The disappointment was maybe, I mean, chemicals, which was down about 5%, but that was due to lower demand, and also the agri-health business, which made a loss over the period. Look, the one thing I think the market does like about the result is they continue to reduce the net debt across their business. They're still very cash generative and are looking to spend capex in places where they can earn a little bit of yield. That said, I mean, the pipeline still looking to grow next year. And you see that in the NAV, which would have grown about 5% over the period.
All right. Let's go to Woolworths. We did see that share price plummeting about 8%. They released their interim results as well. From continuing operations, you saw that turnover improving 5.1%, but same trend that we have seen with a lot of companies where headline earnings per share declined by 7.5%. Is the only mostly headwind-free segment here the food business?
Yeah, look, I think that one must also look at the operating environment that they've been in. I mean, they've had high interest rates. They've had, I guess, pressure on discretionary spend. Their SA business would have been disrupted by large part second half of the year load shedding. On the inventory side, they would have been impacted by congestion at the port. So at a continuing operation level, Woolies grew 5%. One must remember in the comparable period, they would have had David Jones included there as well. So it was a result, I guess, from the paddle side where you did see margins under a bit of pressure. But on the food side, they're still able to grow. I mean, underlying inflation in food was about 9.1%, still below overall headline food inflation. But it's a result, I guess, on continuing EPS. They were down down over 4% over the period. If one looks at, I guess, the growth in the business, they did grow space by about 3%. And the GP margins went up by 80 bips. So it's a result, I think, notwithstanding some of the revenue pressure backdrop, they were able to do well to contain expense growth. One must also remember, I mean, in an environment where there's cash constraints and consumer spend under pressure, they do try and grow their book. And if you look at the Woolies financial services book, it would have been up about just under 5% from new accounts and credit advances.
All right. Well, Nesi, let's get to your stock pick for today. What will it be?
Yeah, so it's a smaller cap property company we've liked for a while. It's SA Corporate. It's a fairly sizable property portfolio of about 6 billion. Look, they're still in a very tough market, but I mean, they were able to grow, I guess, over the last reported period by some 2.5% on a like-for-like NPI. We like what they're doing at the assets in terms of strengthening the tenant mix across some of their big centers like Musgrave, Morningside, and Coachman's. If you look at vacancies in that commercial portfolio, they're under 2.1%. They're managing, I guess, the asset management improvement that they're going to see on the residential exposure through AFCO, where vacancies are about 3.1%. They've done quite a bit on a full year run rate to try and get disposals as well. Would have been 600 million additional that they would have done in the second half, which would have pushed overall disposals up to 1 billion. We like that the strategic focus is still on industrial, where they can get maybe better longer term leases. The balance sheet is strong, no issues. I mean, it's at an LTV of 37. But what we would look to find is that, the heavy lifting in terms of refinancing they've done already last year in November. The forward yield is very attractive at about 9.5%. And we're expecting, I guess, the run rate in distribution to be on track with inflation for the coming year.
All right. Well, thank you so much for your time and for your analysis on what has been moving investor sentiment today, Nesi. That was Nesi Chetty from Stanlib.